Imagine there is an invisible red line drawn across the global financial system. Most investors never see it. They are too busy watching green and red candles on a trading app. But for the architects of the COMEX, the world's largest metals exchange, this line represents the point of no return. It is known as the emergency threshold. Deep within the CME Group S rulebook lies Rule 432, a dormant clause that grants the exchange the power to effectively hit the kill switch on the market. We are not just talking about a temporary trading halt. According to the CME rulebook, this clause allows for the suspension of trading, the mandatory liquidation of positions, and, in extreme scenarios, the authority to alter the very mechanics of price discovery in real time. We have seen this playbook before. In 1980, the Hunt brothers were not defeated by a lack of demand. They were crushed when the exchange changed the rules mid-game, mandating liquidation-only trading to force prices down. More recently, in 2022, the London Metal Exchange shocked the world by canceling billions of dollars in nickel trades to prevent a systemic collapse of its largest members. As of late 2024, the silver market is flashing identical warning signs. Industry reports indicate that COMEX vault inventories, specifically the registered silver available for delivery, are being drained at a pace that suggests a massive decoupling between paper promises and physical reality. While the public focuses on the daily spot price, insiders are watching the Shanghai Premium, a persistent price gap in Chinese markets that signals the East is pulling the physical floor out from under Western exchanges. You are currently watching a slow-motion wreck in the world's financial plumbing. When that invisible red line is finally crossed, the price of silver will not just move. Analysts suggest it will undergo a violent revaluation, but by the time the headlines catch up, the exit doors may already be locked. Today, we are breaking down the CME RSS crisis playbook to see exactly how close we are to the next emergency condition. To understand why the silver market often hits a structural wall just as it gains momentum, you have to look past the charts and into the ledger of the CME clearinghouse. This is where the math of the margin call becomes a weapon. In the world of futures trading, most participants are not buying silver, they are buying a contract on margin, essentially a high-stakes bet placed with borrowed money. When you trade on a 10-to-1 or 20-to-1 leverage, a small move in price is magnified. But so is the risk to the exchange. Historically, the CME Group uses margin requirements as a steering wheel to maintain orderly markets. However, for silver bulls, this steering wheel often feels more like a guillotine. The most notorious example occurred in April 2011. As silver approached its all-time high of nearly 50 per ounce, the CME intervened. In a staggering 8-day window, the exchange raised margin requirements 5 times. This cumulative hike of over 49% changed the math of the trade overnight. Here's how the vicious cycle of a margin hike functions. Imagine an investor holding a silver contract worth $150,000 backed by $10,000 in collateral. If the exchange suddenly mandates that the maintenance margin, the minimum cash required to keep the position open, must increase from $10,000 to $15,000, that investor has 2 choices. They must either wire $5,000 in fresh cash immediately or sell a portion of their position to reduce their exposure. When thousands of traders are hit with this ultimatum simultaneously, it triggers a cascading liquidation. As the overleveraged players are forced to sell, the influx of sell orders drives the price down. This price drop then triggers stop-loss orders from other traders, which pushes the price even lower. This secondary drop triggers a new round of margin calls for those who were previously safe, creating a self-reinforcing feedback loop of selling. In 2011, this exact mechanism saw silver plummet from $49 to $30 in a matter of days. The price didn't collapse because of a lack of physical demand. It collapsed because the cost of admission for the paper market was raised too high, too fast. As of late 2024, industry reports indicate that the silver market is entering a similarly volatile zone. Analysts suggest that the current paper-to-silver ratio, the number of ounces traded on paper versus the ounces actually sitting in COMEX vaults, is reaching levels that make the exchange nervous. According to the CME vault reports from mid to late 2024, registered silver stocks, which represent the metal available for delivery to settle these contracts, have remained under significant pressure. When the paper market is hundreds of times larger than the physical supply, the exchange faces a systemic risk. If too many contract holders demand physical delivery instead of a cash settlement, the system breaks. To prevent this, the exchange often utilizes the margin hike as a preemptive strike. By making it more expensive to hold a long position, they force the weak hands out of the market, reducing the total open interest and easing the pressure on their dwindling physical reserves. This is the hidden ceiling of the silver market. While the Shanghai premium reflects a growing physical demand in the East, the COMEX remains the primary engine for Western price discovery. But it is an engine with a governor. Historical data from the 2011 crash and the 2020 liquidity crunch suggests that whenever silver begins a vertical ascent, the margin weapon is drawn. For the retail investor, this math serves as a sobering reminder. In a centralized exchange, the house doesn't just set the rules. They can change the cost of the game while you in the middle of a winning hand. The vicious cycle isn't a glitch in the system. It is a feature designed to protect the clearinghouse, often at the direct expense of price discovery. If the margin hike is a scalpel used to bleed out market momentum, Rule 432 is the sledgehammer. Hidden within the CME Group rulebook, specifically under the Enforcement of Rules, in Chapter 4 lies the provision for emergency actions. To the casual retail trader, this is mere fine print. To the exchange and its clearing members, it is the legal basis for what analysts often call the nuclear option. Rule 432 does not merely suggest intervention, it grants the board of directors absolute authority to take any action they deem necessary to maintain orderly markets during what they define as an emergency condition. But what specifically triggers this authority? According to the CME's clinical legal text, the definition is intentionally broad. It covers everything from any act of government and war to more nebulous triggers like any other unusual, unforeseeable, or adverse circumstance. Essentially, if the exchange determines that the physical delivery mechanism is under systemic threat, such as a short squeeze that risks the solvency of major clearing members, Rule 432 can be activated. When this switch is flipped, the exchange ceases to be a neutral facilitator and becomes an active intervener. The rule allows the board to suspend trading, mandate that all positions be liquidated for offset only, or even fix a settlement price by executive decree. This is not a theoretical ghost story. It is the blueprint used during the most significant interventions in commodity history. In 1980, the silver market wasn't broken by a natural shift in demand. It was frozen when the exchange enacted liquidation-only rules, effectively barring any new buyers and forcing the Hunt brothers into a corner where they could only sell into a collapsing bid. More recently, the 2022 LME Nickel crisis provided a modern parallel. When prices doubled in a matter of hours, the exchange didn't just halt trading. They took the unprecedented step of retroactively canceling $3.9 billion in trades. They didn't do this to protect the integrity of price discovery. They did it to prevent a domino effect of defaults among their largest institutional members. As of late 2024, the legal infrastructure of Rule 432 remains the ultimate force majeure shield for the COMEX. Industry reports indicate that in a scenario where silver enters a parabolic price discovery phase, the exchange maintains the right to settle contracts in cash rather than physical metal. This is the exit door problem. A contract holder might believe they are entitled to 5,000 ounces of silver, but under Rule 432, the exchange can legally decide that the contract will be settled in paper dollars at a price the board deems unfair, which may be significantly lower than the prevailing physical spot price in non-Western markets. This creates a fundamental decoupling risk. As we observe the widening Shanghai premium and the continued drain of registered silver vaults, the mathematical probability of an emergency condition being declared increases. For those navigating the silver market in late 2024, Rule 432 serves as a clinical reminder. In the paper market, you don't own the metal, you own a promise. And according to the CME's own bylaws, that promise is subject to change the moment the system's survival is at stake. While the COMEX uses legal fine print like Rule 432 to manage its paper liabilities, a physical force is pulling on the market from across the Pacific. This is the Shanghai Shield, and it represents the greatest threat to the Western paper-to-silver pricing model in decades. To understand the COMEX drain, you have to understand the fundamental difference between how silver is traded in New York versus Shanghai. In the West, silver is often treated as a financial derivative, a number on a screen used for hedging or speculation. But on the Shanghai Gold Exchange, or SGE, The market is primarily driven by physical delivery. As of late 2024, a significant price decoupling has emerged. Industry reports indicate that silver on the SGE has consistently traded at a premium compared to the London and New York spot prices. At various points in the latter half of the year, this Shanghai premium has climbed as high as 10% to 15% over Western quotes. This premium acts as a physical vacuum. In the world of high finance, a price gap of this magnitude is a massive incentive for arbitrage. Large-scale institutional traders can buy silver at the lower paper price on the COMEX, demand physical delivery of the metal, and then ship those bars to China to sell them at the higher SGE price. This isn't just a theoretical loophole. It is a mechanical process that is currently hollowing out Western inventories to satisfy Eastern demand. Data from the CME daily stock reports throughout late 2024 highlights the severity of this drain. To grasp the stakes, it is crucial to distinguish between eligible and registered silver. Eligible silver is metal stored in COMEX-approved vaults, but it belongs to private individuals or institutions and is not for sale on the exchange. Registered silver is the only metal actually available to satisfy futures contracts and delivery warrants. Analysts suggest that as the Shanghai vacuum pulls metal east, the registered category has come under sustained pressure, dropping to levels that historically precede major price discovery events. This creates a structural shield for Eastern investors. While Western prices can be influenced by the margin weapon or high-frequency paper short selling, the SGE price is anchored to the reality of physical scarcity and industrial demand in the world as primary manufacturing hub. As of late 2024, we are witnessing a great migration of silver. For every ounce that leaves a COMEX warehouse to capture the Shanghai premium, the Western exchange loses a piece of its ability to maintain the credibility of its pricing model. If this trend continues, the COMEX drain leads toward a systemic breaking point. If the registered vault totals fall too low, the exchange cannot fulfill its delivery obligations to the arbitrageurs. This is the moment where the paper-to-silver ratio, which industry reports indicate has reached extreme multiples in 2024, collapses under its own weight. At that point, Rule 432 becomes the only thing standing between the exchange and a total decoupling of paper and physical prices. For those watching the vault data, the message is clear. The East is no longer following the West's lead. Instead, Shanghai is setting a physical floor, and the drain is the sound of the Western market's leverage being liquidated, bar by physical bar. To understand the threat facing silver in late 2024, we must confront the ghost that haunts every modern commodity exchange, the 2022 London Metal Exchange, LME Nickel crisis. This wasn't just a market glitch. It was a total systemic failure that provided the modern blueprint for how an exchange can, and will, protect its largest members at the expense of price discovery. In March 2022, nickel prices underwent a vertical short squeeze. As prices doubled in a matter of hours, surpassing $100,000 per ton, the LME faced a terrifying reality. A massive short position held by a major Chinese industrial player threatened to bankrupt not just the holder, but several of the exchange's clearing members. Instead of allowing the market to settle the debt through the natural mechanism of price, the LME took the unprecedented step of invoking its emergency powers. They halted trading, and then, in a move that shattered global trust, retroactively canceled $3.9 billion worth of valid, completed trades. This is the ultimate expression of force majeure. It proved that in a systemic crisis, the sanctity of the contract is secondary to the survival of the exchange's institutional plumbing. As of late 2024, industry reports indicate that the silver market is exhibiting pre-break symptoms nearly identical to those seen in the LME nickel market just before the collapse. The first symptom is the physical drain. Just as nickel inventories in LME warehouses plummeted before the squeeze, COMEX-registered silver totals have come under sustained pressure as the Shanghai premium pulls physical metal out of Western vaults at an accelerated rate. The second symptom is the paper-to-physical decoupling. Historical data from previous market stresses suggests that when the ratio of paper claims to physical ounces reaches extreme multiples, as some analysts suggest it has in the latter half of 2024, the exchange becomes structurally fragile. The market begins to function on a fractional reserve basis. In this state, any sudden surge in physical delivery demands acts as a bank run on the vault. If silver enters a parabolic price phase that threatens the solvency of major bullion banks, the CME does not need to invent a new strategy. They simply need to follow the nickel playbook. Under the broad authority of Rule 432, the exchange could declare an emergency condition based on unusual or adverse circumstances. This would allow them to mandate that all positions be liquidated for offset only, settle contracts in cash rather than metal, or, in an extreme scenario, cancel trades that occurred during a disorderly price spike. The LME Nickel event taught the world a hard lesson. In the eyes of an exchange, a fair price is whatever price allows the system to remain standing. For silver participants in late 2024, the ghost of the LME serves as a clinical warning. When the system is pushed to its breaking point, the rules of the game are rewritten in real time. If you're holding paper silver during a force majeure event, you're no longer holding an asset. You're holding a promise that the exchange may no longer be able or willing to keep. To understand how a systemic collapse actually unfolds, we must look past the charts and into the mechanical crisis playbook of the exchange itself. As of late 2024, the structural tension between physical scarcity and paper leverage has reached a level where a 72-hour market freeze is no longer just a tail risk scenario, it is a clinical possibility. This is a minute-by-minute simulation of what happens when the COMEX nuclear option, Rule 432, is finally triggered. The clock starts at hour zero, the breakout. Imagine a Tuesday morning in late 2024, a combination of a sudden geopolitical flare-up and a fresh stock report showing registered silver vaults at multi-year lows triggers a massive wave of institutional buying. Silver gaps up 3 hours and minutes, hitting the CME's daily price limit. Under standard procedures, trading is halted for a cooling off period. But instead of the usual resumption, the price limit up is hit again immediately upon reopening. As of this moment, the paper market has lost its ability to find a price because there are no sellers, only a vertical wall of buying, buy orders. By hour 12, we enter the margin weapon phase. Historically, when volatility threatens the solvency of clearing members, the CME Group doesn't just watch, they move the goalposts. Mirroring the mechanics used during the 1980 Hunt Brothers squeeze and the 2011 silver peak, the exchange announces an emergency margin hike. This is where the systemic plumbing begins to leak. This margin hike isn't designed to stop the price from rising. It is designed to force speculators out of the market. For a fund holding 1,000 contracts, a $10,000 per contract hike requires an immediate $10 million in cash. If they can't wire the funds by the next morning, their positions are force liquidated. This creates a flash liquidation where the price of paper silver may actually plummet while the price of physical silver in the real world continues to skyrocket. By hour 36, the crisis reaches the bullion bank pivot. Behind the scenes, the large commercial banks, the shorts who provide the exchange's liquidity, are facing a mathematical nightmare. As physical silver continues to trade at a massive premium in Shanghai and London, these banks find themselves unable to hedge their exposure. Industry analysts suggest that in a vertical market move, the unrealized losses on these short positions could exceed the total capital reserves of the clearing members themselves. At hour 48, the CME Board of Directors officially invokes the full weight of Rule 432, Section 1. The exchange declares an emergency condition. This is the 72-hour freeze. Trading is suspended indefinitely, but the real drama happens in the legal fine print. Under this rule, the exchange has the authority to mandate that all existing contracts be liquidated for offset only. This means you cannot take delivery of the metal. You can only sell your contract back to the exchange at a price determined by the CME, not the market. By hour 60, we witness the LME echo. Just as the London Metal Exchange did with nickel in 2022, the COMEX may determine that the recent price action was disorderly. Hypothetically, they could invoke the power to cancel trades or settle contracts in cash, rather than the physical silver the buyers were expecting. For the investor holding paper silver through an ETF or a futures contract, the force majeure realization sets in. You don't own the metal, you own a claim on a system that has just declared itself insolvent. Finally, at hour 72, the new reality emerges. When the exchange finally reopens, it is no longer the primary venue for silver price discovery. The Shanghai shield has held firm, and the physical price in the East has completely decoupled from the paper reset in the West. The 72-hour freeze has protected the bullion banks from bankruptcy, but it has cost the COMEX its most valuable asset, credibility. This simulation isn't just a what-if exercise. It is a walkthrough of the existing mechanical architecture of the modern financial system. As of late 2024, the paper-to-silver ratio remains a coiled spring. Rule 432 exists specifically because the exchange knows that one day that spring will snap. In the 72 hours that follow, the difference between owning silver and owning a silver contract becomes the most expensive lesson in the history of the markets. As of late 2024, the strategic playbook for silver is no longer about predicting a price target. It is about navigating a liquidity trap. When Rule 432 is invoked and the nuclear option is triggered, the market bifurcates into two distinct worlds. On one side is paper silver, including futures and highly leveraged ETFs, where the participant is effectively a creditor to a system that may be declaring insolvency. On the other is physical silver, where the participant remains an owner of a tangible, unencumbered asset. For those analyzing the structural differences between instruments, the distinction between the Sprott Physical Silver Trust, PSLV, and traditional futures contracts is critical. Historically, industry reports indicate that PSLV is structured as a closed-end trust with metal held at the Royal Canadian Mint, offering a higher degree of physical allocation transparency than the authorized participant models used by major ETFs. However, in a vertical limit-up scenario where the COMEX is frozen, even the most robust funds can face a temporary decoupling from the underlying spot price as the Shanghai Shield pulls global price discovery eastward. The primary directive for surviving a market halt involves addressing counterparty risk. In a systemic stress test, any asset that requires a financial institution to fulfill a promise is structurally vulnerable. This is why many institutional observers emphasize the concept of unencumbered ownership. If an exchange mandates a cash settlement under Rule 432, the paper holder is force liquidated at a price determined by the exchange's board, not the open market. By contrast, physical metal held outside the banking system remains entirely outside the exchange's jurisdictional reach. As of late 2024, market participants are increasingly focusing on a crisis checklist to audit their positions. This includes verifying the force majeure clauses in their brokerage agreements and assessing the difference between allocated and unallocated accounts. Experts suggest that during a 72-hour freeze, liquidity in physical markets often evaporates at the retail level, meaning the time to secure a position is before the limit-up cycle begins. Ultimately, the goal in an illiquid market is to ensure that a position cannot be erased or settled by a third-party boardroom vote. When the trading screens go dark and the sell button is disabled, the mechanical reality of the silver market becomes clear. You only truly own what is beyond the reach of Rule 432. As we move deeper into this high-stakes environment, the playbook shifts from chasing speculative returns to ensuring that when the system finally resets, you still hold the asset you paid for.